This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
When first introduced to the idea of chargeable gains, it was back in Chapter 12 when we were dealing with then CGT, capital gains tax for individuals. And what we learnt, as we'll see reiterated here in the second short sentence, is the chargeable gain arises on, I hope you remember this, a chargeable disposal of a chargeable asset by a chargeable person. Now that was on our introduction back in Chapter 12 to CGT. We then saw in corporation tax in Chapter 16 that companies don't pay capital gains tax. Instead, what do companies do? They pay corporation tax on their chargeable gains. Indeed, as we know, a UK resident company will be liable to corporation tax on its taxable total profits, and its taxable total profits will include its worldwide income and gains. So companies will be subject to corporation tax, as we've seen the computation of over the last few chapters, subject to corporation tax on its chargeable gains. So UK resident company, chargeable on its worldwide gains, not that we're going to have an issue with our syllabus in terms of overseas assets, and may dispose of a chargeable asset, not only by sale, but this of course is the single most likely issue you are ever going to have to deal with in terms of an examination question involving capital gains and companies. It will be because the UK resident company has indeed sold off a chargeable asset and therefore a gain must be computed. But if you remember, again going back to CGT and individuals, there were a number of different ways by which an individual may chargeably dispose of an asset, and therefore, if it is a chargeable asset, a capital gain would have to be computed. Now, the other most likely one for individuals was where we gave an asset away. Individuals may make gifts of assets during their lifetime, of course, there. Now, of course, we're not going to see a company giving anything away. But another method of chargeable disposal was the rather more unfortunate one, and mentioned here, but also on the loss or destruction of an asset. And we'll have a separate section within these chapters now on companies and chargeable gains to deal with that. Now, you will recall, I trust, that when we dealt with individuals and calculating gains, the calculation was a very simple one. All we needed to do was pick up our sales proceeds from the information in the question, take away any selling expenses that may be incurred, such as the agent's fees, legal expenses, and that would give you the net proceeds. From those net proceeds, we would take away any and all allowable capital costs. Now that would be the original cost, plus expenses incurred in acquisition, again things like legal costs, and thereafter any enhancement expenditure, any capital improvement in that chargeable asset, that cost would also be allowable. Now, what we'll discover here that the calculation of the gain, so far as a company is concerned, begins in exactly the same way. You will do a repetition of the calculation I've just talked you through. Proceeds less selling expenses, less any and all allowable costs. But instead of that figure then giving you the chargeable gain, what we'll now get is what we'll refer to as an unindexed gain, because companies get a deduction in calculating their chargeable gains that individuals do not, and it's something known as Indexation Allowance. Now, we made reference to this back when discussing our introduction to CGT, but it's only companies that get the benefit of this relief. Now, this Indexation Allowance is a simple idea, and that is that we should give relief in terms of the capital gain that is deemed to arise. We should give relief for the effects of inflation. Now then, the idea being, if we now sell an asset for £200,000 that we bought for £100,000 10 years ago, then for an individual it would be simple. Sold for 200, cost 100, chargeable gain £100,000. End of story. But when dealing with corporate tax, we get, we might even say, fairer here. And what we acknowledge is this, that When we sell for 200, we bought for 100, there is now what we call an unindexed gain, indeed, of £100,000. They then take account of the effects of inflation. Now, we'll see how we measure inflation in just a moment's time in these notes. But if, for example, we said that from when bought 10 years ago to sale date now, inflation has gone up by 20%, then actually a cost of £100,000 10 years ago, taking account of inflation, would be a cost of £120,000 now, with an increase in inflation of 20%. So that indexation allowance, that movement in terms of inflation, that gives us an extra deduction of their £20,000. Effectively, rather than merely deducting a cost of 100, we can deduct an index cost of 120. However, what we must do is to always show separately the deduction of cost, 100,000, and the deduction of indexation. Now, the indexation allowance is simple enough to compute. If the movement in the inflation, level of inflation, has gone up by 20%, then take 20% of your original allowable cost incurred. 20% of £100,000 is 20,000, and show that as a further deduction from the unindexed gain in deriving chargeable gain. Now, that's the basics of it, giving relief for the effects of inflation, which seems like a perfectly reasonable and fair thing to do. Right, so return to our notes now here, still in section 1. As we'll see in note point 1.2 below, there we go, that's the calculation of the gain or loss for companies. We'll come to it in a moment. The calculation of the gain contains one new component, not applicable for individuals, but for companies we are given a deduction from the gain, now known as unindexed gain, to remove the effects of inflation. Like in my example of a moment ago, inflation on a cost of £100,000 over the 10 years at 20% would be an increase in that cost to 20,000. Remove the effect on the gain of inflation. So, remove the effect of inflation from when the asset was purchased to when it is sold. This deduction, as we know now, is known as indexation allowance. So far as our chargeable disposal is concerned, therefore, not just sale, but very occasionally a loss or destruction of the asset. A chargeable person, a company will be a chargeable person. A UK resident company is liable on its worldwide gains there. And finally, in this first section, as we saw in relation to personal tax, CGT for individuals, all assets are chargeable assets unless they are specifically exempt. Now, we may recall that back in Chapter 12, we had a very complete list of those exempt assets, and that was we're dealing with individuals. But now the main exempt assets that we're ever going to see being disposed of by a company would be motor vehicles. Again, motor vehicles that have an ability to have a private use of them. Motor vehicles, they will be exempt. Qualifying corporate bonds. Yeah, again, a company may hold an investment in the form of corporate loan stock. And basic corporate loan stock is known as a qualifying corporate bond, and you may recall seeing that one also in your list of exempt assets. And also certain chattels, again, as we all know in terms of outright exemptions, chattels, those that are wasting chattels are exempt, though there'll be issues here for companies so far as plant and machineries are concerned, but we'll look at that later. But also chattels where we buy and we sell for less than £6,000, then they are exempt. You may recall, of course, that there are then special rules which deal with should you buy a chattel for less than 6 but sell it for more, or buy it for more than 6 and sell it for less than 6, then there are special rules dealing with either the calculation of the gain or the calculation of the allowable loss. Main assets we're ever going to see being disposed of by a company. Now, these are shares. Now, we'll recall when dealing with disposals of shares by individuals, what was the key problem? The key problem was if an individual had bought shares in a particular company over an extended period of time, so multiple purchases at different costs, the problem was when you sell some but not all of those shares, which ones were you selling? Because if you did not know, you could not then determine cost. If you cannot determine cost, then you cannot, of course, determine the gain. So here we will see in this particular chapter, indeed, once we've gone through this basic introduction to how we calculate gains and losses so far as companies are concerned, we will then deal with the specific issues pertaining to companies. They will have slightly different rules in terms of how it is we identify on a disposal shares that have been sold by a company. Which ones acquired do we relate that to? Slightly different rules. Plus, of course, another problem here, and that is that in relation to any cost on any shares disposed of, there must be indexation allowance. So that brings in another issue there. We'll see that soon. Other than shares, obvious assets that a company may own, land and buildings, and also plant and machinery. These are the main assets that we're ever going to have to deal with so far as corporate tax and capital gains are concerned. But as I say, more of those as we go through the ensuing chapters. But let's just remind ourselves now, in terms of what we have just been discussing, about the basic calculation of gains and losses for companies. And to begin with, it is exactly the same as for individuals. We work down to what we now label as an unindexed gain rather than a chargeable gain. How do we get there? Disposal proceeds or market value. Now, a company is not going to give anything away, but what we might see is where we've had a loss or destruction of the asset, and how do we deal with that? More of that later. But what do you sell it for? Proceeds less selling expenses, get your net proceeds, take away any and all allowable costs, remember original cost plus enhancement expenditure, and we get what we would now call the unindexed gain. Now, of course, we do not always make gains. Sometimes, sadly, our allowable costs will be bigger than our proceeds, in which case we would make a loss. Note very carefully before we go any further, this note here on our indexation allowance section, that the indexation allowance cannot increase nor can it create a loss. So if we are talking about a capital loss being made by a company, it's there. That is your allowable capital loss on the disposal of a chargeable asset by a company. Indexation allowance, I repeat, note that well there, cannot increase nor may it create a loss. But if it is an unindexed gain, then we are able to deduct this new component, indexation. Now notice what we've said, cannot increase nor can it create a loss. So that deduction there for indexation allowance, once you have computed it, cannot be greater than the unindexed gain. You cannot turn what was an unindexed gain into an allowable loss. The chargeable gain that would then arise at this point here would be, if you can see what I've written in there, nil. The indexation allowance can only bring down an unindexed gain to nil. So I repeat, indexation allowance, so far as corporate tax is concerned, and you only see it in corporate tax, cannot create nor can it increase a loss. But most of the disposals that we will have to deal with in any exam question or questions will involve, no doubt, gains. So we do then have to compute that indexation allowance. Even if we end up with a nil gain, we have to calculate the indexation allowance. So what have we got? Section 1.3 here. Right, as we have said, for companies only, not individuals, the increase in the value of an asset due to inflation is not taxable. So we need to work out what is the effect of that increase in inflation. That increase is removed from the gain by way of indexation allowance. We get the unindexed gain, then we take away indexation, and that then gives us the bottom line chargeable gain. How do we calculate it? Companies, here in Note B, are entitled to an indexation allowance from the month of acquisition until the month of disposal of an asset. So we will be told when we bought and when we sold an asset. And as we'll talk about separately in a moment's time, if we have incurred separate enhancement expenditure at a date after, obviously, we had acquired the asset, then there will be a need for more than one indexation allowance calculation. There would be one such calculation for each amount of allowable cost incurred. Now, we're never going to see ridiculous scenarios of several enhancements. We may have probably just an original cost, and then every now and again in questions we have an amount of enhancement expenditure. And we've got to work for each such amount of cost what indexation allowance is there. Now, what we've got to do is to base this movement in terms of the inflation of effect on the business. We've got to measure that by reference to some acceptable inflation measure. And in the UK, that particular reference is to the Retail Prices Index, or as we'll know it from now on, the RPI. Those of you working in the UK will no doubt be familiar with the RPI. Those of you not, again, I'm sure that in every country they have some measure of inflation. For us, the one that we use here for capital gains purposes, it is the Retail Prices Index, the RPI. Now, what we need to see is by how much has that RPI gone up from when we bought the asset until when we have disposed of that asset. And we've got to measure that movement, that increase in the RPI, in a certain way. We'll see now how we do it in the form of what we call an indexation factor. An indexation factor that is then multiplied out, it is applied to the cost involved. And that will give us that effect of inflation. It'll give us the indexation allowance on that cost. In our little chat of 5 or 10 minutes ago, we said that when we bought an asset to when we sold an asset, if inflation had gone up by 20% and our original cost was £100,000, then the indexation allowance would be 20% of that 100,000, and that therefore would be £20,000. Now, how rather more precisely, because the movement in the RPI may not be a nice simple round 20%, how do we calculate this so-called indexation factor? Well, look at the calculation that we've got here. This is what you now need to learn. Now, the RPIs will be provided within the question. Usually at the bottom of the question, you will see reference to RPIs. Now, those RPIs will be given for months and years, maybe one or two extra ones over and above that which we actually need to see whether we are able to choose correctly the relevant RPIs. So what do we want? We want, as we said, the RPI for the month of disposal, and there we go, first RPI in this calculation, there on the top line. And we're trying to look at the increase in the RPI from when we bought to when we sold. Easy. RPI for month of disposal minus the RPI for the month of acquisition there. Nice and simple. And we need to reflect that increase on a base of what was the RPI for the month of acquisition. So in terms of RPIs, we're given an RPI now when we sell, that is the month and year in which we sell, and we're given an RPI for what it was, what the RPI was, in the month and year in which we bought. So we want the increase in the RPI over what the RPI was when we bought. It's a sort of RPI now minus what it was over what it was. Now minus was over was, if you want to put it in very basic terms. So work out the increase in the RPI over what it was when bought, and you express that. Now again, note D here, look at this. The increase in the RPI is expressed as a decimal, and is rounded to 3 decimal places. Now, in example 1 in a moment, we'll show you how to do that precise calculation there. But what we're going to do is to express it as an indexation factor, taking it, because it won't be a nice round number, to 3 decimal places. What that effectively will represent is the percentage increase in the RPI from when you bought to when we sold. One final point, we know that we don't always have inflation. It's been some hard years indeed over the time since the financial crisis, back at the end of the 2000s. But if the RPI had fallen from the month of acquisition to the month of disposal, then the indexation allowance will be nil. You don't end up with a negative indexation there. The worst that can happen for the company is that it is nil. But let's have a little look now at an example. And how it is we calculate this gain. Right, calculate the chargeable gain arising on the disposal of the asset. So what are we told? Company bought an asset in June 86. There they tell you what the RPI was. Again, you're probably going to find the RPI information down here at the bottom of the question. That's where you're probably going to get it. And we bought that in June 86, this asset, it's a chargeable asset, at a cost of £20,000. Since we bought it, we incurred enhancement expenditure amounting to £6,000, and that was in August of 1990. And again, we must know the level of RPI at that date. Ultimately, of course, we only have a gain because we dispose of the asset, and the asset is sold for £100,000 in October 2015, and there we have our RPI. Incidental selling costs, our selling expenses there are, what's that, £1,000. Right, now what I want you to do for me here is, just as we've always done, calculate the gain as you would for an individual, but label it as an unindexed gain. Prior to which, of course, we'll then be doing, we'll be calculating the indexation allowance. So work down to an unindexed gain, which is simply following exactly the same rules as you learnt for individuals. What do we sell for? What are the selling expenses? Get the net proceeds, deduct each and every allowable cost, and get what we then call unindexed gain, and we'll then prepare to deduct indexation allowance therefrom. I'm sure that you are probably able to do that for yourself, but at least if you work to the unindexed gain, I'll then take you through the calculation of our indexation factors and apply them to each figure of cost, original and enhancement, and we'll work out what then indeed will be the chargeable gain arising in relation to this disposal. So if you could do that for me now, please. So stall this, pause this for a moment, and then come back and we'll see what we should have done and go on to deal with the indexation. Okay, well, hopefully we're looking at a calculation that looks pretty much the same as the one you can see here. We know that we sold this chargeable asset for £100,000. In so doing, we incurred selling expenses of £1,000, and hence our net proceeds here of £99. Again, in terms of an exam question, you don't actually have to label that as net proceeds. Again, that is obvious as to what it is. So again, obviously we don't want to waste any time in the exam. Using your time-based division, you don't have to label net proceeds. That's what it is though, 99,000. Take away. Show each allowable cost figure. The original cost, 20,000, and then as it was here, one particular instance of enhancement expenditure when we incurred £6,000 of allowable cost. Again, we'll talk more of this analysis of cost later, but the enhancement expenditure has to, of course, be an allowable capital cost. If it's merely a repair expenditure, then that is revenue and is not to be taken account of here. That would be a deduction against your trading profits of the company, assuming that we're dealing with an asset used within the trade. So only capital costs, not revenue, not something like repairs expenditure. And we get what we've now called our unindexed gain. Again, in the exam, you don't have to label that unindexed gain. Obviously, if you're doing calculations as an answer to an objective testing question, you don't have to write anything other than pick the right answer there in terms of those offered on your answer sheet. But we will now deduct the indexation allowance from that unindexed gain. Now, because there is more than one figure of cost, both an original cost and also enhancement, then each of these separate cost figures must be indexed by their own relevant indexation factor. So for each of them, we now look at that calculation of how it is we work the indexation factor. So we're going to multiply out the cost of 20,000 by its indexation factor, taken to 3 decimal places, and enhancement expenditure, again by its indexation factor. So how do we calculate those indexation factors? Now, again, as a separate working, or again we can fit it in here if we prefer, what do we look at? Firstly, in relation to each of these disposals, you want the RPI now at the month of disposal. Let's do this in relation to the cost. Month of disposal, what was that, October 2015, we're assuming an RPI of 259.5. Now, away from that, we must take out the RPI for the month of acquisition and put all of that over that self-same RPI for the month of acquisition. So the cost, when did we incur that cost? Back in June 86. And in June 86, what was the RPI? We are told it was 97.85. So RPI now at time of disposal, 259.5, minus the RPI that it was at the month of acquisition, 97.85, all over 97.85. Now you'll put that through your calculator and you will get an indexation factor, which you take to, following the decimal place, 3 decimal places. Now what I got that to, as obviously here inflation is more than 100%, is 1, which would effectively be 100% increase in the RPI from when you bought to when you sold. 1 point, and I made that to be 652. Again, rounding to the nearest 3rd decimal place. So get that indexation factor, rounding to the nearest 3rd decimal place. Now once you've got your indexation factor, simple. Apply it to the allowable cost, so 20,000 times 1.652, and that would give you your first figure of indexation allowance. So let's put that through our calculators. 20,000 times 1.652 will equal, I made that anyway, £33,040. £33,040. And that's the first deduction that you're able to apply in respect of the effect of inflation as it is in terms of your original allowable cost. So now what we've got to do is to apply exactly the same technique in terms of establishing the indexation factor to apply to your enhancement expenditure. So you therefore have a go at that now, please. We know what we need to do. What is the RPI now? 259.5 minus then what it was at the point we incurred the enhancement expenditure. What was that RPI? Over that self-same RPI, what it was when we incurred the expenditure. Take it to the nearest 3rd decimal place, apply that indexation factor to your enhancement expenditure, and you will get, yet again, your indexation allowance. Take it all away, and we will then have our bottom line figure of chargeable gain. That is what we're searching for, the chargeable gain figure. So, pause this for a moment if you haven't indeed already calculated that figure of indexation factor and indexation allowance. Pause for a moment and then we'll just see what our final answer should be. Well, hopefully if we're both indeed using our calculators the right way, our indexation factor should come out at 1.026 there, being the RPI now at month of disposal, 259.5, minus what it was when we incurred the expenditure, 128.1, all over 128.1, and take it again, as we said, to 3 decimal places. That would be 1.026 we've established, multiply out by £6,000, and that should be 6,156. We've now got our figures of available, indexation allowance, and we deduct those from our unindexed gain. When we take those figures away, all being well, that brings us down to a chargeable gain of £33,804. Remember, if here the indexation allowance had it been more than the unindexed gain of 73, then that would have been a nil gain. No allowable loss may be created, nor indeed may it be increased by the use of indexation. Here, not an issue, we've got more than enough unindexed gain to cover all of the indexation allowance. Therefore, a chargeable gain of 33,804. So there we go, our basic process of calculating the gain for companies, merely one new component, the allowable deduction of indexation allowance. You'll be provided with RPIs for when you sell and when you incurred that expenditure. You work out an indexation factor to apply to your allowable cost figure. Now, if it's more than 100% in terms of the effect of inflation, as here, it'll be 1 point something. Here on costs, 0.652, on the enhancement, 1.026. If, of course, it was less than 100%, the indexation factor would read 0 point, then take the figure to 3 decimal places after that again point. Hopefully all okay in terms of our chargeable gains calculation. Again, just pause for a moment, have a review through, make sure you're happy with that before we continue on. Okay, on to just the final little issue of dealing with gains and losses so far as this particular session is concerned. What you'll then see on the screen in front of you is in our next session together, we'll look at how we deal with disposals of shares so far as companies are concerned. Whereas in our introduction we said the main issue will be one of recognising when a company sells some but not all of its shares that it owns in a particular company, then what is the allowable cost? You might want to go back and remind yourself of how we dealt with this situation for individuals in terms of the share matching rules and the different ways by which then we may acquire or indeed dispose of shares. What we saw back then was, as well as going out and buying shares, the individual may take the benefit of a bonus or a rights issue, or we may end up having bought shares in one company to then be selling shares in a different company because of a takeover scenario that occurred. It would be useful prior to our next session here on corporate tax gains for you to remind yourself of those rules for individuals. We will then see how that needs to be adjusted and dealt with for corporate tax purposes. But the final little point here, what happens in terms of gains and losses. Now, we know that capital gains are of course chargeable to corporation tax. Again, from the very outset, we know a UK resident company is liable on its worldwide income and gains. Capital losses, when they arise only when net proceeds are less than any and all of our allowable costs. I repeated yet again, indexation allowance may not be used to either create nor to increase a loss. So far as the accounting period is concerned, remember the corporate tax computation is prepared for a chargeable accounting period. That is normally the same as the company's period of account, the period for which it has prepared its accounts there. So what we will do is to calculate each individual gain and loss for the accounting period. So capital gains and losses arise in the same accounting period, they are netted off. If, of course, the resulting figure is a gain, then that is what features as chargeable gains within your corporate tax computation. Go back to your pro forma corporate tax computation, having calculated trading income. We would then bring in any property income and any interest income there. We would then include chargeable gains. Those net gains are what we would now be including on the corporate tax computation. If, however, the resultant figure were to be a net loss, so there are more allowable losses than there are gains, then you cannot offset that capital loss against your other income. All you would do is to put in nil as the gains. Remember, when we had losses before, if you had a loss in relation to your trading income or property income, then you would put in a nil assessment. We do not put a negative bracketed figure. So if you have net losses, chargeable gains nil, and what do we then do with the loss? Well, very simple. It is carried forward and set off against future gains. So in the next accounting period, having incurred net losses, you would do the same exercise. What would the gains and losses of that next accounting period, get the net gain? If it is a net gain, we may then deduct from it the capital losses brought forward. Only, of course, as to then reduce those gains down to zero, and then we would continue carrying forward any remaining amount of capital loss. So capital losses brought forward may only be relieved against capital gains, not any other type of income. So both within the accounting period in which the loss is made and when carried forward, there is only one object in terms of the set-off of that loss, and it is capital gains. If there are insufficient gains this period, the net loss is carried forward and set off against future years' net gains. If those future years' net gains are not initially big enough to absorb all of that loss, you keep carrying forward that loss until such time as gains are found. What we may see reference to in materials, both this and whatever other text, if any, you may be using, and in terms of answers to exam questions in revision kits, we may see the terms capital gains and chargeable gains being referred to as the same thing. They are interchangeable, therefore. Right, get to grips then with the basic calculation of the gain or loss. It's pretty simple, really. The only new component coming in is the availability of indexation allowance to reduce an unindexed gain down to the chargeable gain, or lowest to nil. Next lecture, what we do is to start to look at some of the practical and specific circumstances of gains that we may have to indeed compute, and that would firstly deal with the disposals of shares. As said prior to that, worth having a quick recap for you back on the disposals of shares for individuals. So not that you'll need to know specific memory of the techniques there, but the scenarios. So what were bonus issues? What were rights issues? How did we deal with takeovers there? How did we construct a share pool when dealing with the disposal of shares? That will be useful to you for the next session together.